Thank you very much for joining me on this video. You know, if you've taken my Money Machine seminar, or if you've watching these videos week by week, you'll know that I'm a big believer in acquiring investment property. But I also need to warn you that it is deferred gratification. You're going to have the work, you're going to have the anxiety of tenants, and you're not going to see a big payoff now. You'll see a big payoff in the future. And for that reason, I really strongly encourage you to do annual net worth statements. What do I mean by a net worth statement? Well, what I want you to do is I want you to compile a list of everything that you own and put down its current market value. What could you get if you sold it? Now I want you to make a list of every debt you owe. If it's a Visa bill, for example, not how much you pay monthly, but what's the principal balance outstanding. Every debt, and then total that. And then when you take the total asset value and the total debt amount, and you subtract the debt from the asset, what you're left with is your net worth. And I don't really care if your net worth is zero. It isn't what it is, it's where it's going. I am really interested in seeing it grow. I want it to grow year after year, and that's why I tell you to do an annual net worth statement. And I not only want to see it grow, I want to see it accelerate in its growth. So how does your net worth grow? Well, when it comes to the money machine and investing in real estate, it grows in two ways. The one way is through paying off the principal. Every payment that you make to the bank or lending institution or whoever holds the mortgage, part of that payment goes to reduce the debt. It's paying off the principal. And the shorter the amortization period, the more that's paid off on each payment. And so the amount of equity you have in the property grows with every single mortgage payment that you make. And the nice thing is the tenant is paying that off. But there's another thing that gains your net worth through property ownership, and that's capital appreciation. Properties are going up in value. Now you say, well, Wayne, they don't always go up, and that's true. We saw them drop in value in 1980, we saw them drop in value in 1990, and we saw them drop in value post-COVID. Sometimes there's a correction and there's a slowdown, but overall, they will always go up in value, and they will always go up in value at a greater rate than the cost of living. Why do I say that? Because of population growth and because of scarcity. More people on the earth, more people in Canada, but not more land. And so that creates upward pressure mobility on prices. So between your capital appreciation and your debt reduction, you are seeing your net worth grow and grow and grow. And each year, you'll be excited to see that figure. Here's the problem though. As it grows, it hits $300,000, $500,000, $700,000, $1 million. You see your net worth in that figure, and you think, gee, I'd like to get my hands on that money. There's all kinds of things I could do with that money. There's a Lamborghini that's just waiting to sit in my driveway, or I want to go on a European tour, or I just had it with tenants. And you decide, I want to sell, cash in my chips. And that's a very real temptation. Don't give in to that temptation. I understand because you're not seeing the payoff now, but look down the road. You will see the payoff one day in the future in the form of passive income. If you absolutely have to get your hands on some money, refinance the properties that you own if you must. Now that'll slow down your eventual payment when you see the properties paid off, but it means you at least keep the equity, you keep the ownership, and some people will say, well, I want to take the money out to buy another property. Well, here again, if you're wanting to get at the money that's the equity in your existing property to buy another property, don't sell the property, refinance the property. Why do I say that? Because if you sell the property, you're going to have to pay capital gain. If you depreciate it, you're going to have to pay recapture. You're going to have to pay legal costs. You're going to have expenses, and so you're not going to have 4 quarters for $1 to buy another property. You're going to have taken a step backwards. If you refinance, sure, it's going to take that much longer to pay that property off, but you're going to increase your base if you use it to buy another property. So it makes a lot of sense to do that. One last thing I want to leave with you is even more important than your net worth is take a look at your cash flow analysis. You want to know how your money coming in is making out. Do you have a surplus? How much is that surplus? And when we're talking about surplus, don't forget that surplus isn't just how much money's in your pocket. Bear in mind you're trying to pay these mortgages off. So it's also how much money is going in debt reduction of the principal. Those two things are how much those properties are earning you monthly and annually, and that's part of your cash flow. And so too, eventually, is the interest, because one day that mortgage is going to be paid off. There will be no interest, and the amount you're spending now on interest will be money in your pocket as well. So always keep an eye down the road. It's not today, it's in the future. And one day you're going to have really substantial cash flow that you can retire on and enjoy a quality of life. I've used the analysis before, I'll use it again. It's like having a goose that lays a golden egg. You don't want to kill that goose. You want to keep it in good shape and keep those eggs coming. For a number of years, it's going to be growing your net worth, it's going to be reducing the debt, but eventually it's going to be funneling that Maserati or Lamborghini in the driveway and that trip to Europe. Thank you very much for taking the time to watch this video. I'll talk to you again next week.